Welcome to Business with Teacher T. So we're back to looking at some businesses that operate in the private sector. In a previous Teacher T video, we looked at sole traders and partnerships. In this video, we're going to be looking at companies, private limited companies and public limited companies. Operating as a company can overcome many of the difficulties faced with being a sole trader. Incorporated businesses are companies and have a separate legal entity from its owners. The two main types of incorporated companies are private limited companies and public limited companies. Private limited companies and public limited companies have their own legal identity. This means they also have limited liability. Therefore, the owner is only liable for their original investment if the business were to fail. So, for example, if a shareholder invested £4,000 in a business and it were to fail, they would only lose the £4,000 that they put in. They would not lose their personal belongings. Without this protection, there will be less investors willing to invest their money. Right, let's take a look at private limited companies. Private limited companies can be small or large businesses. Some examples of private limited companies are Misguided, Lego, and Iceland. Private limited companies are required to have Ltd after their name. Setting up as a Ltd means that a business will have to have registered with Companies House. Ltds are owned by shareholders, each owning a share in the business. They are all known to the company. Shareholders have to be invited by the business before they can purchase shares in the Ltd. There is also a lot of paperwork and legal formalities that have to be completed and approved before becoming an Ltd. The directors, who are responsible for all the day-to-day management with running an Ltd, some of them also tend to be shareholders. Finally, with an Ltd, there is limited liability. Here are some further examples of private limited companies. Okay, let's take a look at some advantages and disadvantages of private limited companies. One advantage of a private limited company is that there is limited liability. Now, as we know, limited liability means that the shareholders will only lose the initial stake of the money that they've invested in the business. Now, this is a huge advantage, as it means if the business were to fail, they would not lose their house, their car, or any valuable belongings. They would only lose the money that they've invested in the business. Another advantage is that it's easier to raise capital, which is money that is invested in the business. They can take on new shareholders, and this gives them the ability to have further capital. Another advantage is that they are in control of who buys shares. There's normally a process where they can control who new shareholders are. This process cannot be undertaken with public limited companies. And finally, the business will still continue even if one of the shareholders dies. There are, however, disadvantages to private limited companies. Let's take a look. One of them is that profits have to be shared between all of the shareholders. So unlike a sole trader, where they're able to take all of the profits for themselves, this is not the case for private limited companies. Another disadvantage is that shares cannot be sold to the general public. So for private limited companies, they cannot advertise on the stock exchange, they cannot sell their shares to the public at all. So therefore, that means their ability to raise finance is somewhat limited. Finally, if one shareholder decides to sell shares, then it may take time to find a new shareholder. As a business grows and wants to expand, they may decide to become a public limited company. Time to take a look at public limited companies. Public limited companies have the term PLC after their names and include well-known businesses such as Urban Outfitters and Amazon. Most PLCs started off as private limited companies that went public in order to raise further capital for development and growth. Now, one of the ways that PLCs can raise further capital is by offering its shares to the public on the stock exchange. One of the requirements of becoming a PLC is that a business must have a minimum of £50,000 share capital. And finally, a PLC has a limited liability, which, as we know, means owners are only responsible for the amounts that they have invested if the business were to go into debt. Here are some examples of public limited companies, most of which you should be familiar with. Let's look at the advantages and disadvantages of public limited companies. An advantage of a PLC is that there is limited liability. Limited liability is a tricky area for many students, so if you need further understanding of that, you could watch my video on limited and unlimited liability. Another advantage of a business being a PLC is that huge amounts of money can be raised from the sale of shares to the public, as there is no limit on the amount of shareholders a company can have. The money raised can be used to expand the business, reinvest, or it could even be used to fund new projects like a new product line. Another advantage is that it is easier to raise finance, as accounts are audited by external bodies. Therefore, banks and lenders have more confidence in a company's performance and can be more willing to lend to PLCs. A final advantage is that a company gains a prestigious status when being a PLC. Adding the PLC at the end of the name gives a company a sense of prestige that a private limited company does not have. However, there are disadvantages of public limited companies. One disadvantage is that the setting up costs can be very expensive, as at least £50,000 has to be issued in shares in order for it to become a PLC. In addition to this, there are other further legal and administrative costs that will need to be paid for. Another disadvantage is that there is a possibility of a takeover, as shares are available to the public. If a shareholder bought more than half the shares available, they will have control of the business. And finally, a PLC has to publish their accounts every year. This information must be available to everyone, and this means that even competitors will have access to information that a PLC might not want them to have. Thanks for watching this video. If you're liking the business vibe, don't forget to subscribe.